Such a strange way, right, of doing things. My goodness. Feels like television or something. All right. Yeah, I think now it's live. Let me just mute here. Yes. So let me start. Just wait a minute so we can start on time. So people are coming. Okay, let's. Okay, let me start. So, hello everybody. Welcome to the monthly edition of UCL AI Insight series. I'm your host, Adriano Koshiyama, a research fellow at UCL Computer Science Department. Taking place monthly, the series will focus on a range of pertinent topics and discussion areas in the field of artificial intelligence. Each event will provide detailed insight into a different aspect of AI technologies, and will incorporate the views of several leading experts. All of the events will be streamed live on the center's YouTube channel with the opportunity for viewers to put their questions to the panel. Please subscribe to our YouTube channel and Twitter page for future events. The first event in the series is entitled Adoption of AI in Financial Services. In this series, we will be exploring how AI technologies has been implemented by industry in the past and present, and present possible avenues for further adoption from what academia and startups and industry are developing right now. We will also discuss the key barriers for more adoption, particularly the risks that emerge when humans are taken out of the loop and opaque decisions are being delivered without challenge. To talk about this topic, the speakers composing our panel today are Ana Perales and Dr. Lucas Pruch. Ana Perales is the AI and Conceptual Next lead in Barclays Ventures, a team created in 2018 focused on developing new business lines, promoting innovation, and driving returns within Barclays. Ana started her career in strategic consulting after completing a PhD in organization strategy. She joined Barclays in 2003, working on a number of roles, from operations to product development. Lucas Pruch is a reader at the School of Mathematics at the University of Edinburgh. He's also the Director of Finance and Economics Program at the Alan Turing Institute in London. Previously, Lucas was a Nomura Junior Research Fellow at the Institute of Mathematics, University of Oxford, and a member of the Oxford Mann Institute for Quantitative Finance. Lucas has also a broad research interest in machine and reinforcement learning, statistics, and game theory. Unfortunately, Lara MacDonald from the Center for Data Ethics and Innovation is unable to attend due to professional issues. However, I'm happy to announce a last-minute speaker, Professor Philip Treleaven. So Philip is the director of the UK Center for Financial Computing and Professor of Computing at UCL. 25 years ago, his research group developed much of the early fraud detection technology and built the first inside dealer detection system for the London Stock Exchange. And for the past 16 years, Professor Treleaven research group has developed algorithmic trading systems, working on regulation, systemic risk, and RegTech with the Bank of England and the FCA. His current research includes the application of machine learning and blockchain technology to financial compliance and regulation, and in the area of computer executable contracts. So on this note, I would like to thank my speakers and thanks Professor Philip for filling the gap as in the last minute. So my first intervention would be to have some kind of a mini interview with Professor Philip And I would love, of course, involve Lucas and Anna also asking some questions. But I'll just start with a question with Philip, more a question about the past. So 25 years ago, you did probably the first real-world application of AI in finance. Could you tell us a little bit more about it and how was its reception?
Yes, you've just reminded me that we actually started off a very long time ago trying to use neural networks for forecasting the dollar Deutschmark, and it was a total disaster. It was quite interesting. And it's interesting to look back on why neural networks are a big deal now, and what we did was dreadful. And a lot of it is to do with, actually more data, faster machines, etc. The interesting thing about the stock exchange is often with innovations, organizations come to you when they're in a bind, or that they can't do something, and this has happened on a number of occasions with us. And the stock exchange came along and said, we've got this terrible problem to do with insider dealing, and we don't know how to tackle it. And there was a lot of pressure in the newspapers. And I did what I do now, which is we've got all these really bright students at UCL. We've got 300 PhD students, 600 master students. You ask who'd like to work on it, and and 4 of my PhD students built what turned out to be the first insider dealing detection system, probably one of the first AI-based systems in finance, and it worked remarkably well. The first time they ran it, it identified 7 people that looked like they were engaged in insider dealing, and 5 of them were actually then prosecuted by the exchange. And the interesting thing is, we weren't trying to automate everything. All we were doing is saying, actually, these 7 people look a bit dodgy, or to use the right word. Fast forward a few years ago, I was having lunch with a very famous person in finance, and he said, "Oh, I remember that time." He said, no one would trade unless they had insider knowledge. You didn't need an AI system to identify insider dealing. You could have chosen 7 people at random with a good chance of catching 3 of them that weren't doing it. But anyway, it was an interesting comment. And then the same sort of thing happened about 16, 17 years ago, when there was a lot of discussion about automated trading. Or automating trading, and it's surprising now when just algorithmic trading so embedded in the financial markets. At that stage, it wasn't clear. People weren't sure whether it was going to work, and we and Deutsche Bank developed this fixed income system, and it worked really well. And I remember the head of trading at Deutsche Bank saying, it's pretty obvious what's going to happen. He said, just roll it out across all the asset classes. And that then was a trigger to stimulate all the other companies to respond with automated systems. And interestingly, for the last few years, we've been trying to get the insurance industry to take an interest in automation. And recently we've got what seems as a pioneering project with Britex, where they're trying to automate, insurance markets. And so it's a sort of rerun of what the capital markets were about 16 years ago.
Yeah. Just kind of following on this topic, I remember I was in your room, and a time ago, you told me about this lunch you had with some stockbrokers in the early days, and I think you told them about this idea of home broker. What was their reaction?
Yeah, it's quite interesting because it's happened on, it's like a Groundhog Day scenario. This time I was with a group of senior stockbrokers, and I said we were going to try and automate share trading. they laughed. They said, "You're an idiot." They said people don't want to trade shares on computers. They want to come and have lunch with people like me and get the benefit of my 25 years experience, as a professional. And I said, what about Joe Public, the person in the street? They laughed. No, I'm not interested in those. And very quickly, sort of 5 to 8 years, there's just a total transformation. And this has happened on numerous occasions. You could say that, that legal services, still haven't made the transition. And, some firms will, started to do automation, but most of the senior partners in law firms, still, probably they're thinking, "Oh, I'll be retired in 3 years. Who cares?" But in lots of sectors, when automation comes along, you have this same situation, that the people that are doing very well currently in the sector are the last to change. Yes. And as I pointed out to some of the insurance companies, that Alibaba and Tencent got together with Ping An, the big Chinese insurance company, and within 1 year, online, they'd done 600 million insurance contracts. That's online, and these are the sorts of things that aren't on the radar often of the insurance companies, but it's a tsunami type situation.
Yeah. I'll just make a final question before I open the floor to the other speakers, but for them to ask you. But my last question is, like, what do you think are kind of the biggest drivers of innovation and changing you're seeing in the financial sector right now?
Yeah, you might expect me to say, the new disruptive machine learning algorithms like GANs, LSTMs, transfer learning, etc. But I'd like to point out two things. One is Lucas is involved in Edinburgh's got a ton of money to do open finance. That's a potentially big deal. So not just banking, but insurance, pensions, the whole lot. And the other thing is that a number of the offshore financial centers are trying to completely automate, and that set up a sort of financial market involving government, financial services, including registration and regulation. And so I think that it's a sort of financial ecosystems are going to change. And the key thing is that established markets, like New York and London, need to take on board the fact that new players, possibly Singapore, which is also an established market, or even some countries that we don't even consider, could actually just set up an Amazon for financial services and have a huge impact on global financial services. And as Amazon's shown, it's a sort of winner-take-all situation. So this is no time for complacency. And what the coronavirus has done is, I said before the coronavirus, we're talking about a data-driven revolution. It's a sort of 5-year journey for lots of organizations. But with the coronavirus, it's now become a 5-month journey that you need to scramble. And it's incredibly difficult to get successful organizations to actually take on board innovation.
Yeah, I just now open the floor to Anna or Lucas if they want to make some questions to Professor Philip.
Anna, you want to start, or you want me to start?
You go, Lucas. Right. I'll follow you.
Just a couple of small questions. So when you mentioned the open finance and early on, Adriano mentioned your work on using blockchain and RegTech. So of course, there's this idea that technology allows to design distributed markets, and financial system at the moment is very, very centralized. How realistic it is that these big players with a lot of money and a lot of power will let smaller new initiatives, be at the forefront? What are the chances, or how long you think it might take us to get to this more decentralized, fairer financial system?
Yes, the big players will certainly try and stop it, but if it's a startup or particularly a new country, if they actually embrace it, then the customers will go with the flow. So if you look at companies like Vanguard, that's taken on board investment, they've grown hugely. And I guess they must have been around, but they come from in my vision, from nowhere, and therefore it's quite likely that a lot of the financial institutions, will either change or disappear. Two interesting phenomena. When I was a PhD student, or soon after, there were huge American IT companies like Digital Equipment, Burroughs, Wang, the Control Data Corporation, and then one day I woken up and they'd all disappeared. It wasn't a case of me seeing them decline. They were no longer around, and these were companies that were operating in multiple countries, huge factories, etc. It's just they tried to stick with mainframes and disappeared. The other one, which I think is even more telling, that after the war, the biggest car producer in the world by a long shot was the UK. And you look at the UK car industry now, it's largely disappeared. And therefore, at least the Germans who have recognized this has happened to the UK and are starting to push back. But it could be in 5 years' time that even the German car industry could be put out of business, by Korea, Japan, China, Vietnam, because those are the countries with the battery technology. So the reason I use these examples is this is no time for complacency. We've seen this in other sectors like retail and such like. And the difficulty that large financial institutions have is actually doing innovation. And I remember talking to the head of trading at one of the big investment banks, and this is sort of 16 years ago, and he'd said, we'll never be able to compete with hedge funds because it takes us 9 months to get a server into the bank. Yeah, they don't recognize that the biggest problem isn't competitors, it's their own inertia in actually adopting new technology.
Thanks.
And just one question from me, more related to the governance aspect. I'm curious, we obviously now have a very big focus on governance of algorithms and the risks of algorithms, transparency, explainability. Given that you've got experience of actually doing that for 25 years in the market space, how have you seen that evolve from 25 years ago to now? Have things changed?
Yes, obviously regulation has changed out of all recognition. Although there were I remember at the FCA, when the FCA were reactive, and I've been there with the journey when they've gone now to being the sort of leading innovator, and everybody's trying to catch up. And the reason that the FCA was actually pushed by the Treasury was actually to regulate fintech companies that were clearly becoming more and more important, but at the same time encouraging innovation. And what we're seeing now with data sovereignty, things like even TikTok and what the Chinese have done to keep Google and Facebook and all the others out of China, is that data sovereignty is becoming more and more important. And the problem is that there's an element of data sovereignty for actually trying to grow your own financial services industry, but it also is a tool for managing decline. Okay, and it's a fine balance. So it'll be interesting to see what happens. But for example, at the moment, I guess that the Chinese financial services industry, with things like WeChat, Tencent, Alibaba, Alipay, and things like that, probably 5 years ahead in consumer finance of what the West is. And obviously, Donald Trump's pushing back, with things like TikTok and banning WeChat. So I think there's going to be a sort of balkanization coming. It's pretty obvious. But there's two things. You can either nurture your own industries to respond and innovate, or particularly in the European Union, you could easily see legislation actually being used to manage decline rather than protect. So it's a dangerous time for countries and for companies.
Yeah. We'll just make a final question that I've received in the chat to Professor Philip. So they're asking, like, you are a professor, so you're kind of involved in the universities and academia, and have been teaching people. How different is to teach finance today, or computer science and AI, compared to, let's say, 20 years ago, 10 years ago?
Can I answer your question indirectly?
Okay.
The biggest change that's happened in the last 5 years is actually the academic researchers, and especially PhD and master students, getting involved in commercialization.
Yeah.
Before, and still to a large extent, universities are a little bit like monasteries. They sit around having deep thoughts, but they don't actually, do anything apart from producing, illuminated manuscripts or something. But now, with things like DeepMind and a lot of the innovation is actually going into innovative startups. So if the biggest change I've seen in education is we need to actually give the students not just an education in doing research and about technology, but actually how to actually produce things, and get them out the door. I think this will be the big change. And our Conception X program, supported very kindly by Barclays, has been sort of pioneering in this way in actually changing attitudes.
Yeah. Thank you very much. I think that's. Is there any other final questions or any final point? But because I think we kind of need to move on to the next speakers. But
you don't want to ask a question about the exam for NASCO? No, I'm surprised.
not in this series, but maybe down the line.
Okay. Thanks for inviting me.
Thanks, Professor. Bye-bye.
Goodbye.
So just to now, just going back now, and then now moving on to our next speaker, which I think is Dr. Ana Perales, and she will be presenting us her view from the industry on this topic, and see how we can move forward with AI adoption in financial service.
Thank you, Adriano. So if I start by perhaps giving a context of why I'm actually interested in AI and what I've been doing in the past few years as the AI Horizontal and Conception X lead. As you said, Barclays Ventures is all about finding new revenue streams, etc., but really focused on what is the role of technology in that journey. When we looked at artificial intelligence about a few years ago, we actually realized that within the bank, we had a lot of data science expertise and a number of people working on different proof of concepts. And we sought a way of actually bringing those communities together to really bring together the best practice, but also lessons learned on how to do things internally, but also how to work with the external world. So as part of that, I'm part of the Center of Data Science within Barclays without being a data scientist myself. And I'm also very keen in actually connecting to different universities to understand what innovation is happening in the space of AI, not just the data science, which is probably beyond my expertise, but actually the governance and accountability. And in doing that, the ability to bring together and connect with centers like this one to really understand what the nub of the discussions are in financial services, what the regulatory framework is happening, and what the innovation activity is happening within the startup community is all very interesting. So in the context of actually these Insight series, I actually cast my mind back to what are the main trends of interest that I really have an interest in and that I see a lot of activity happening. The first one really is around the use cases for AI. And I would start by saying that actually one of the most interesting spaces, and I'm not going to say anything new or controversial, is really the concept of executing real-time predictions. And whilst that actually covers a whole host of things, and within the fintech space, there's a lot of activity in actually doing that real-time prediction at alternative lending mechanisms, but even the kind of financial coach, personal coach are really activities where you're really trying to predict something that's going to help the consumer make something happen. The other area where, internally we're always looking at new ways of working is really the identifying and prevention of fraud. And that's where actually real-time prediction, or if possible before it happens, and actually finding new techniques and ways of doing that are really areas of interest. The second topic really is categorization, which again covers a whole number of activities. From a personalization perspective, we're always interested in understanding, how can we actually meet customers' needs in a much more personal way. But then when we look at the concept of understanding our customers in the way that they interact with us, the challenges of actually finding the right data, merging data, analyzing it, processing, etc., really comes to life in terms of the type of AI technologies and how we can use them to solve those type of problems. So from a trends of interest, the opportunities I see really falling into how do we make the most of data? And one of the kind of areas that I always find really interesting, even though it's very, very well developed, is the natural language processing techniques. Because actually, given the broad range of data sources, structured and unstructured, that we actually have as financial institutions, really tapping into that and maximizing the potential of that data is absolutely critical for us. And it'll really help us have a step change in the way we understand our customers, and we develop journeys, products, and services that really actually meet their needs. One of the projects that we have done in the past is actually looking at all those data sources within the complaints journey, which have data sat in very different areas, to really understand and have actionable insights out of complaints, rather than stay at a superficial level. And then the second bit really, and Lucas might touch on this, is the exploration of alternative data sources and how different data sources, different ways of data sharing, different ways of actually coping with the very important data privacy aspects, and also different methods for feature engineering and modeling are areas that we really all need to explore, both in the startup community, but also in the incumbent community, and in partnership with academic institutions and regulators, so that we can really focus on how do we do that transformation that Philip was talking about. Finally, 2 areas of focus, and I'll finish there. I'm really involved and very interested in actually understanding how the governance of artificial intelligence is progressing. There is so much activity from a regulatory perspective, but actually it's the combination of what are the right processes, what are the right tools, and what are the right cultures to make sure that we're looking at bias, fairness, explainability, and transparency of algorithms. That is an area of focus that we're always looking into. Part of it is actually, do we understand as a big institution how to make sure that we've got visibility and control of all the AI activity that might happen, which is why connecting those data science teams is really important. And then finally, and perhaps much more current, is actually what is the impact of the pandemic on our existing models. Again, back to data, but the data that we've been using to train our models has really been focused on very different behaviors, both financial, but also individual companies, in terms of predicting certain factors like, likelihood of default, etc. And there is a risk that those models will degrade as we actually move in a post-COVID world to very, very different behaviors and live data feeding into our models. So actually looking at how we cope with that and how we address it is also another area of focus. Hope that was helpful, and I will leave it there.
Thank you very much, Anna. Really appreciate. We have like several questions now popping up everywhere. I'll make my question, then I'll open to Lucas also to ask you, and then I'll kind of pick from the chat and from different channels. I'm receiving emails, I'm receiving things in the Zoom group chat and in the YouTube channel. So my first question is, like, you are managing this portfolio of different startups that is coming with ideas that are kind of coming up from research, most of them. And you have this kind of data science capabilities internally at Barclays at the same time. How you can blend both at the same time? I mean, like, because sometimes you have a startup with a very cutting edge idea, but sometimes you have an internal unit doing that, and it's like there's some kind of conflict of interest or something like that. How do you manage this relationship?
Well, one of the things that I've found in the past few months is actually the setting up of that Center of Enablement of Data Science brings together a whole load of very like-minded individuals in the interest of actually understanding what's new on AI. And that is my forum to be able to bring in new ideas. So that's where I actually would take, we found this new startup, you were talking about explainability, they're talking about explainability, do you want to meet them? Or I feed into the latest ICO report on XYZ really needs to be looked at and see what the impact is. What is interesting from that perspective is it is then for those teams that are doing the work, both the startup and the internal team, to really match what the need is versus what the solution. And I think in that conversation, apart from really setting up the introduction, making sure that the right context is in place, the need has to be matched. As a big institution, as you can imagine, working with smaller companies is much harder, and therefore we normally traditionally hope that we can actually get close to doing some sort of proof of concept. The challenge with that is the moment you actually have to move into sharing data, it does slow things down, but that's where we try to actually move mechanisms and have the right processes to smooth things down.
Yeah, thank you. I'm not sure if Lucas will come back, but just wanna, oh, he's back. So I think he's gonna, I think now he's coming. Yeah, so go ahead, Lucas.
Yeah, so actually I want to touch on this last point, the data.
Yeah.
Data sharing. So, finance industry historically works with data that is proprietary. And so there are huge restrictions in terms of, sharing data, not even outside organization, even within organization, right? So how you go about it, where is your thinking at the moment, or where is the future perhaps?
Oh, well, I'm not sure I can read the future, but I think, so there's a number of things around data. One is making sure, and we've been doing it for years as financial institutions, is really understanding where your data is coming from, what permissions you have with the data, and therefore who you can share it with and not. Given that we are such a big financial institution, those type of things really take quite a complex mechanism to maneuver and run through when you're actually trying to type into more than one database. So actually that's really where the kind of organizational structure and having data owners that really have the responsibility and accountability for knowing in that data set, who can they share it with, what can they do with it, etc., is one of the areas that we make sure we work with. So part of my job is to make sure that I know who the data owners are, or I can find out who they are. So that's one angle. I think the other angle is really understanding what is the structure and content of the data that we want to share? What is the scope for it to be anonymized from a more simple method to a much more complicated method? And what is the risk of the type of data that we're sharing in terms of something going wrong? And that is really what then determines the levels of security that we really need to put in place. In addition to that, then I'm always interested in actually having a look at what's happening in the academic space around new ways of obfuscating data, new ways of actually understanding how valuable a synthetic data set could be, and really having the right processes to make sure that we can control what data we can share or not. But it's not an easy question, and it's really important to make sure that we protect our customers' data, because that's what we're there for.
Thank you. Thanks.
Yeah. Just fielding to you on a question from that we received from the public. From an industry perspective, what kind of regulatory intervention, if at all, would you think would be appropriate, at least let's put it this way, in the short term and in the medium term, so we don't need to look a long time ahead? Just like right now, what do you think should be the right balance? Should be something like GDPR, or maybe what we have at the moment? How do you feel about it?
Oh gosh, it's a challenging question, and I wouldn't be able to represent the full Barclays views here. Yeah. But what I can, I mean, obviously GDPR is extremely comprehensive in actually making sure that we have the data protection rights properly covered. I find a lot of the consultations that we're doing in terms of working with the European Commission on the AI expert group consultation, the FCI, the ICO project on explainability, are really providing much more insight and light into how we should be approaching these problems. From my perspective, I think the principle-based approach around outcome-based regulation is very important, because otherwise we run the risk of always chasing our tail by regulating a small piece of technology that then evolves, and then suddenly we need to address a new regulatory environment. Whereas the kind of FCA and the UK's regulation in terms of outcome-based, focused on fair customer outcomes, really gives us the right steer to make sure that we address things. Some of the areas where there's been white papers really around auditability and explainability are extremely helpful to really perhaps provide some sort of standardized approach for all of us to be thinking about these problems in the right way.
Yeah. So just a question before, it's a more general question about kind of Barclays in this case. Question like, how mature is Barclays in terms of AI adoption? If you have maybe to put on a scale, it's like, how is it at the moment, and maybe what would you like to see going forward?
So I couldn't really rate the whole of Barclays. As I say, I'm very impressed by the number of data science teams and data science experts we have across the whole organization. True. It is definitely an area of technology that we're actually very, very interested in. We have a team that actually works on research and development of technology, not just AI, but also other technologies like blockchain, and even exploring the quantum aspect of new technology. So we will be more developed in those areas where it's absolutely critical, like fraud, for example, and perhaps more cautious as to how we apply some of the more novel techniques to kind of customer-facing applications. But I think we will accelerate in our pace. Yeah,
it's very good. It's very good. In fact, I now have a question, which is maybe for Anna and for Lucas as well. So the question is from Lakshmi. she asked, hi, being in risk model development, I can see that AI and ML are yet to catch up mainly in regulatory models. How do we convince the stakeholders to leverage advance in AI and ML? And I think she's basically trying to frame the question as how can we incorporate kind of the machine learning and etc. Into the usual traditional risk model development that banks have, etc.
I think her views, I will be interested in her views, because that is one of the challenges we all need to be familiar with. Part of the aspect that we need to be very, very conscious of is we need to understand the impact on the customer, and we need to be able to explain how we are delivering our products and services to our customers. So exploration of AI and ML is always going to be within those constraints, because our dedication is to get the right outcome. So one of the ways in which we're doing it is actually trying to look at doing experiments that allow us to compare different methodologies and different data sources against what a traditional format is, to see whether performance is increased, whether actually that output can be explained. And in doing that, we can then show and train the rest of the business where the benefits are and where the areas for development are. Lucas, you might have other experiences.
Yeah. So my very brief presentation, I think, will touch on that point a little bit. But I think it's a very big question. It very much depends which corner of financial system you have in mind. So, for example, this very quantitative side of finance, derivative tradings, and hedge funds, mainly derivatives tradings. This is a part of finance that have been using quite complex models for a few decades now. They have fairly large, very specialized teams. You could argue whether the models they use are explainable or not. They're perhaps explainable to people with enough technical knowledge and less explainable to everyone else. And they have big validation teams in place, trying to make sure that those models deliver what they intend to. And so model risk framework has emerged after financial crisis in 2008, especially that is enforced by Fed. In the United States, in Europe, it is a little bit more left up in the air for interpretation. Is a step in that direction. So now we need to think hard. What are the new risks that AI, and I put a quotation marks because I think that word is heavily overused, is bringing. And again, this will depend on the context. So, for example, in retail banking, the move to using much more complicated models than they used to use is already something we need to think. Doesn't matter whether this is some black magic deep learning method, or this is just much more complex method model that people are not used to working with. Fusing different data sets together. These are all the questions that we need to think. So I think it's very difficult to answer that question generically. You need to have those use cases, and I think this is what we've been discussing and advocating, that I think there is that need for a bottom-up approach here. That what's going to happen, I suspect, in the next couple of years, that more as more use cases we analyze and understand, then some sort of framework, more unifying framework, will emerge from there.
On this note, just want to thank Anna for her presentation. She's going to stay with us. She's not going to leave now. Philip did. And I would like to pass the word to Lucas to do his presentation, and then we are going to follow up with some Q&A.
Okay. Can you see the slides okay?
Yes.
All right. Okay. So very brief. Thanks, Adriana and Emre, for putting this together. I think it's a wonderful initiative. It's a pleasure to be here. And so Emre and Adriana asked me to, in 5 minutes, to summarize what's happening with AI research in finance. So I won't be able to do that, but I just want to touch upon a little bit that model risk and what's actually hiding under the bonnet, at least from my perspective. So a lot of things that are out there that are called AI in the context in applications in finance industry actually boils down to supervised learning. So just to maybe try to understand what is happening, what is the issue with, what is potential issue with black box models, and what's different in comparison to the simpler models that we used to be working with. I have a quick comparison. So for the linear models, for the standard methods that have been used in finance, say, imagine I have specifically in my, say, a mortgage application or loans to the customers as a classical example here. In those simple models that have been used to make the decisions whether someone should get a loan or not, we would use a combination of expert knowledge and some statistical analysis, or basic statistical analysis, to understand what are the important features that we should consider in our modeling. So say, again, in this context of loans, you know, it might be the salary, the amount that the customers wants to borrow, his credit history, etc. And so that would constitute our model. We call those handcrafted features. And then we will use data to understand how important those features are for decision. And we will use some historical data to do that. So the model is explainable, and model is a result of, you know, like I said, research and typically years of working with that kind of models involving industry and academia. As we move into this more data-driven world that we are surrounded with big data sets, it's much harder to actually come up ourselves and handcraft those features to understand which data points, which features are important and might play a role in my decision. So this black box approach, and doesn't matter whether this is some deep neural network or some other complicated models, the premise there is that we start with a large model, some sort of meta model that has many, many parameters. And then we take our data that we try to understand, and we run some, like, more or less complicated algorithm on this. And what happens, this meta model that we start with is so large that there's many combinations of different parameters that would be able to explain the data. That is, there is more than one model that would give us a good fit to the data. You know, I don't want to go into the direction of differentiating between statistical association and causal inference, but this is one of the things that is under the hood. And so, as a result, as we move into this more complicated, more data-driven models, what happens is that we pick one model out of many, and the data, the type of meta model we work with, and even the training algorithm that we use to find optimal parameters in our models are all modeling choices, and we are not always used to think about this that way. So here I have example, and doesn't matter exactly what example it is. So this is coming from my paper. And so what we've done, we look at the application of using deep neural network models for pricing derivatives in finance. So what we've done, when you see on this, on the left-hand side, the plots of different prices that we produce. So in the middle, these are the prices that we generated using a model by, so sorry, the setup here is that the data set that we use is constant. We're not changing data. The model that we use is fixed. The training algorithm that we use is fixed. And all we do, we change one little parameter during our training. And as a result of this, we produce a range of different possible prices. So this is this middle guy. And then then we thought, okay, so which model should we choose? It's not so clear. So then we look, okay, is it possible then to find the maximal price or minimal price of the product that we try to price or find the model. And it turns out that you can. And so as you see, we identified the ranges of many models that are all perfectly calibrated, give you perfect fit to data. So you have mean square errors here at the level 10 to minus 7, 10 to minus 8, producing quite significantly different outputs. So what it means is that in some applications, when you move that kind of thinking to say this loans or mortgages, what you can do, you can find many different models, and each of these models might produce different explanations. Each of these models might score differently on various fairness metrics. And so that's a little bit a part of the issue with using these very complicated models, that we need some extra robustness, and we need to think that those models are capable of producing intervals, and there might be many different answers to the same question. So when there was that question about model risk and what potentially are new things that are coming from machine learning, so I just tried to put a couple of bullet points here. So something I already touched upon is that all sectors and all parts of financial industry begin to use or want to use fairly complex models that are not used to, not familiar with. And so that's risk in itself. We need to upscale people, we need to train them, we need to make them aware, what potential risks are of using the complicated models. The other thing is that many of the machine learning methods that are being developed are methodologies that work for static data sets. So, classification of images is a very static problem, but also playing Go, the DeepMind is doing so well these days, is a very static problem that is not changing. The rules of the games are not changing as by simple the fact that we play the game. This is quite a bit different in finance. So for example, if we will use data to train our models and then use those models to make decisions. Those decisions later will change the data. So if I change how I change the way I'm deciding who will get a loan, that means that I will start giving loans to different people. That means that the data in a few years' time that I will have will be substantially different to what I have today. And what Anna has mentioned, COVID also brought a shock to our economy. So that means that the data that we have today is drastically different than the data that we had a year ago. So that's a challenge for some of the machine learning. The other thing is that it's a little bit more touching about fairness, that this example that I showed you, that there is one can typically find many different models that give a good fit to the data, means that both industry, but also the customers, they would most likely will try to game the system once they know what the evaluation criteria are. So we need to, when modeling and designing those machine learning systems, we need to take that into account. There's of course bias, that's historical bias and data selection. So as an organization, as a bank, say in the context, Anna also mentioned a fraud detection, say the bank wants to train some algorithms to improve the rate of detecting the fraud, but those algorithms are being trained at the data that Barclays have, but they don't have access to the data set that other banks and other financial institutions have in the system, and that person that is committing the fraud can have multiple accounts. So that's, you have that bias coming from the fact that you only train your algorithm on part of the larger set of data. And of course, like I said, there's different algorithms that might give similar answer and dramatically differ on different metrics that are out there. And one of the challenges that have been identified is that lack of explainability. Those models are complicated, though individual parameters do not have any interpretation, which makes it much harder to audit and verify what's actually going on. So my last slide. Thinking about auditing, so we think that there is a great need to start validating and auditing algorithms in finance. A couple of points, to keep in mind. There is more, but this is a brief presentation. And Anna already mentioned that it's really important to have some baseline, hopefully, ideally explainable, that we can compare. We need to understand: do I want to replace certain process by automated by using some machine learning, or maybe actually I'm pretty happy and I would like to just augment it rather than completely replace it. So I need to have metrics for evaluating those different trade-offs. We need to be able to track model performance and also model performance of outputs, but also explanations. Though explanations might not be stable, and if you think about this as a bank, you have an algorithm, you will provide an explanation to your customer. Ideally, that explanation is there to help him to say, for example, in that example of mortgage decision, you provide explaining to the customer why he didn't get a loan. And so then he can work and improve upon a few characteristics. So next time, in 6 months' time, when he reapply, he will be successful. But if that explanation is not stable across the time, that means that it was perhaps useless from the customer perspective. So these are kind of things that need to be kept in mind and tested and validated. This idea of using representative benchmark data set, possibly a combination of synthetic and real data sets for so-called stress testing. So this is a common practice in financial industry, or say Bank of England is stress testing economy by changing a few key parameters, macroeconomics parameters, and asking banks to reevaluate the risks. Similar ideas that can be used for stress testing machine learning algorithms. You want to understand how the methods that you roll out in practice will behave if different data inputs will be fed into them, and you need to have that picture before you're allowed to roll it out in practice. Continuous monitoring, like I said, because the data is changing, the world is changing continuously, then you need to monitor your algorithms and their performance continuously rather than, say, every 6 months. And the final thing is that the algorithms in machine learning are there to help with the decision-making rather than to replace decision-making. So even though we might have an algorithm or data that is biased, and so long as we are aware of this, we can correct for this. So the way we are using algorithm insight provided by more complex models for the decision-making, that should be disentangled, and we need to have a control over that point. So I'll stop here. And welcome any question if you might have.
Yeah. Thank you, Lucas, for your talk. We'll just have like, I think, 4 or 5 minutes to close it up. I'll just have a quick question, which is a little bit like a topical question at the moment. I'm not sure if I should make the question, but here we go. So Larry asked a question in the beginning saying, in light of the recent debacle with the A-levels results, how do you think some of the new algorithm audit tools that are emerging could have helped it? That's,
because I work in academia at the university, I'd rather not to answer that question.
And I have very little expertise, so I wouldn't really even begin to comment. But actually, it touches on something that Lucas was mentioning in his presentation, and I had a question for Lucas on. So moving away from the exam results and focusing on the use of algorithms. Lucas, you talked about the process, and I think that's the very important point to remember, which is algorithms are part of a bigger process, and there's the role of us as humans versus the role of the machine. And a number, I can't remember if it's Accenture or IBM, who talk about human plus machine. I think that's where we should all be focusing our minds. If we have the right processes and we understand the role of the algorithm there, then we're actually able to hopefully understand where the bias, where the risks are. But the question to Lucas is actually, from your experience in terms of AI audit, are there good tools out there to actually measure explainability and fairness, etc.? Or is that an area that really needs much more academic research and looking into?
In terms of research, I think this is very early days. So as you already pointed out, there's a big discussion for the last couple of years among regulators, industry, and academia around ethics, and as a result of that, there's over 100 different guidelines and documents suggesting and pointing what fair, ethical, trustworthy use of AI might be, and broadly everyone agrees on that. When it comes to actually practical, concrete tools, yeah. It's early days. It's early days. We have some research on explainability, on fairness is something that really started, relatively well. If you track it down to the early AI, it was already there, but that intensity is very recent. So there are some metrics for fairness. There are some methods of explainability. My personal take is that a large chunk of those methods actually might be misleading, in that what I hinted on that, and there are results already in literature, what people demonstrated that you can produce different explanations for the same output. So you can, by changing an algorithm slightly or changing your data slightly, in a similar way as people presented these adversarial examples. So I think we need a little bit more work, but one thing that is emerging, and again, this is my view, is that robustness. We need much more robustness in those machine learning algorithms. We need to understand the limits when the algorithm will work and it will not. In ideal world, you would like some sort of certification that would come and tell you, look, if you will put the data with this characteristic, so with that type of data, then your algorithm, range of output might be from A to B, and then it's your decision as a risk officer whether you're willing to take that or not. We are slowly getting there. So I think that robustness is a key, that explanation would need to be robust. The metrics that are being produced around fairness also will need to be robust. And the research in AI over the last 10 years was on accuracy. And now we're realizing that's only first and one point in the much bigger picture, and there's lots of new things coming together. But this is a very exciting field, and I agree that the key is to have a unified framework that industry could use.
Thank you.
Yeah. Well, just as a final wrap-up question, what is, I think, for both Anna and for Lucas in this case, is this application area, or it's kind of a product in a way, this thing called synthetic data generation, like several startups and several ideas popping up, etc. How is this like a panacea? Is it the final solution for many problems, or is this another alternative to test models, to check robustness, etc.? How do you think about this? I've been listening to this all the time, so I'm just asking a question on this regard.
I can very briefly, I'm biased because I think this is a wonderful idea, but it's still early days. So the one thing I like about the synthetic data sets is that when used in combination with real data sets, that's where their power is. So what I mean by that, in this, when we're talking about sharing data or fusing different data sets, you can fuse synthetic data sets to evaluate your risks, because often there is a chicken and egg problem that you, as a risk officer in the organization, need to make a decision whether you want to share the data, and you would like to share that data for some purpose. But without actually having the data, I cannot tell you what exactly I would be able to find out. So how you strike that decision? Whereas if I would be able to give you a synthetic sample, and on that synthetic sample, you could test and evaluate things, how they work, and then bring it back on the original data set, that at least you are able to make more informed decision. And going into using synthetic data sets for the stress testing is an extension of that idea, which is an active research at the moment.
I couldn't add anything to what Lucas has said because he's the expert. So I'll just continue learning because I thought that answer was really interesting and gave me a lot of food for thought.
Yes, yes, yes. I think we're kind of running out of time, and that's a bit of a shame. But I think on this last note, I'd like to thank Philip, Anna, and Lucas for their fruitful participation and insights provided. A special thanks for Emre Kazin. He didn't appear, but he's did a very good deal of the organization. Special thanks for him, and also for Mark for the coordination and content curation. Really special thanks for both of them. Thanks for the UCL AI Center for sponsoring our activities. Thanks for Professor David Barber for giving us this opportunity. Please subscribe to our YouTube channel and Twitter page. Our next event's planned for the 24th of September, so in a month's time, and we will send more details shortly. Goodbye and see you soon.
Thanks a lot. Thank you.
Thank you.